Every crypto bull market repeats the same promise. This time, Bitcoin is different. This time, it's your hedge against inflation, against money printing, against your own collapsing currency. It's a comforting story. It makes chaos feel manageable. No matter what your central bank does, no matter how badly your government mismanages the economy, you have a lifeboat. But then the storms actually arrive. Currencies wobble, markets panic, liquidity dries up. And instead of calmly sailing upward like some immaculate emergency asset, Bitcoin does something far less comforting. It whipsaws. It crashes. It behaves less like an insurance policy and more like a leveraged bet on global risk appetite. So a simple, uncomfortable question hangs in the air. If Bitcoin is supposed to be your hedge against currency failure, why does it keep bleeding whenever the system shakes? And more importantly, what does history say a real hedge actually looks like? This is where money, power, and history collide, and nothing is ever as simple as it looks. Bitcoin as FX hedge sounds reassuring. It is a tidy slogan, 3 words that promise protection from a chaotic world. But markets do not care about slogans. They care about liquidity, incentives, and what frightened human beings do under pressure. In the modern myth, Bitcoin is framed as the next step in a long story. For centuries, when money failed, people fled into something harder, scarcer, beyond easy manipulation. Gold, land, foreign currency. Now, supposedly, code. Digital scarcity instead of metal, wallets instead of vaults, private keys instead of bank accounts. It sounds like a neat evolutionary line, but when you actually follow the historical trail through collapses and devaluations and FX panics, you find something humbling. The things that actually saved people rarely behaved like the posters and memes promised, and Bitcoin so far is no exception. To understand whether Bitcoin is truly a foreign exchange hedge or just another speculative story, you have to go back to what people did before lines on a crypto chart ever existed. Long before anyone stored 12 words in a hardware wallet, people faced the exact same fear you may feel now. What do I hold when my local currency becomes a joke? In ancient and medieval economies, the answer was almost embarrassingly simple. The money itself was metal. When rulers debased coins, shaving off silver, sneaking base metals into gold, everyone understood what was happening, even if they could not describe it in economic terms. Their hedge was not an elaborate derivative strategy. It was hoarding the older, purer coins. It was hiding silver bars, gold jewelry, grain in storage, livestock in the hills, anything that would still be accepted when the emperor's new money lost its shine. Fast forward to the 19th and early 20th centuries. National currencies rise, central banks appear, and printed paper promises spread across borders. When a country's currency looks weak, elites do not write manifestos about uncorrelated assets. They quietly move their wealth into things their own government cannot easily print, freeze, or devalue. Gold in vaults abroad. Foreign currencies issued by stronger states. Real assets, land, factories, railroads, ships. The pattern is painfully consistent. When your own government is the risk, your hedge is something that government does not control and cannot conjure out of thin air. By the mid-20th century, after 2 world wars reshaped the globe, one currency rose above the others as the default safe harbor, the US dollar. When your local notes looked suspect, you saved in dollars. In bundles of cash, in offshore accounts, in dollar-linked bonds and deposits, gold, dollars, and tangible assets became the core toolkit for surviving currency chaos. Gold did not need a brand campaign. The dollar did not require memes. They proved themselves by surviving crisis after crisis in relative terms. Not perfectly, not without losses, but compared to the currencies that burned down around them, they looked like bedrock. It is easy today to talk about FX hedging as if it is just a menu option in an app. History does not care about your tidy allocation percentages. It cares about survival. Look at a few brutal snapshots. In Weimar Germany in the early 1920s, the mark collapsed so violently that prices doubled in days. People were paid with stacks of notes and rushed to the shops before the value disappeared between morning and afternoon. Salaries turned to dust. Savings became a bad joke. Who preserved purchasing power? The ones with claims on something outside the dying system. Those who held foreign currencies. Those with gold and hard goods. Those who owned businesses that produced real things people still needed. In the Asian financial crisis of 1997, currencies in Thailand, Indonesia, and South Korea cracked under the strain of external debt and speculative attacks. Overnight, safe local deposits lost huge chunks of their value in global terms. Middle-class savers learned that when your currency is the thing being repriced, banks and balances do not protect you. Those who held dollars or dollar-linked assets suddenly found themselves able to buy local property and businesses for fractions of their former price. In Argentina, again and again, the script repeats itself. The peso breaks, capital controls appear, bank deposits are frozen or forcibly converted into weaker units. Official reassurances about stability dissolve as quickly as the currency itself. And again, the people who make it through the best are those who manage to keep something outside the system. Dollars under mattresses, real estate with utility, productive businesses, foreign accounts, connections abroad. Whether anyone likes it or not, the historical FX hedge has almost always been some mix of foreign hard currency, hard assets, and the ability to move. Not because they are morally superior, because they are what actually survived when governments panicked. Into this harsh, unromantic reality walks Bitcoin with one of the boldest promises in financial history. It does not present itself as another tool. It presents itself as the tool, the antidote to central banking, the answer to inflation, the exit from bad money. It was not born as a portfolio product. It was born as a revolt. The white paper appeared in the ashes of the 2008 crisis when trust in banks and central banks cratered. The famous message in the Genesis block about bailouts and chancellors was not decoration, it was accusation. Traditional finance had failed. A new system was proposed. Over the next decade, every crisis that touched Bitcoin became a chapter in a growing mythology. When Cyprus debated seizing depositor funds, Bitcoin's price spiked, and the story wrote itself. When banks steal, this is your escape hatch. When Greece closed banks and imposed capital controls, commentators pointed to Bitcoin as digital smuggling, wealth that could slip through borders with no customs check. As Venezuela, Lebanon, and others spiraled into inflation and banking collapse, more voices added the same refrain. This is what Bitcoin was built for. The message hardened. When your government lies, when your bank fails, when your currency dies, Bitcoin is your lifeboat. Gold for the Romans, dollars for the Argentines, Bitcoin for the 21st century. It is a compelling narrative. But markets are not bound by narrative arcs. They are bound by flows of money, leverage, and fear. If Bitcoin truly functions as a foreign exchange hedge, then in a crisis, two things should generally be true. In a collapsing local currency, its price in that currency should rise, and ideally, it should at least hold its value, if not rise, against stronger global units like the dollar. The first part often appears to be true. If your local currency is melting, almost anything globally priced looks like it is soaring locally. A second-hand Toyota imported from abroad, a bag of imported coffee, a share of a US tech company. Bitcoin is no exception. When your unit of account is collapsing, the chart goes up for everything that trades in a harder reference frame. But that alone does not prove hedge status. That is arithmetic. The harder test is how something behaves when global risk sentiment flips, when the dollar surges and everything else is scrambling for liquidity. That is when real hedges earn their name. Over and over in those moments, Bitcoin has behaved less like digital gold and more like a leveraged tech stock. When global markets panic, investors sell what is most volatile and most liquid first. Funds facing margin calls do not care about manifestos. They dump whatever they can. Bitcoin is thrown into the same bin as high beta equities. Retail holders who swore they were in it for the long haul suddenly discover their pain threshold. Extreme drawdowns shake out those who never really understood the risk. That is not a moral failing. That is human physiology meeting brutal volatility. So yes, for someone in a hyperinflating currency, Bitcoin's local value may skyrocket. But relative to the dollar, or relative to a basket of traditional hedges, it may be plunging at the same time. As a tool for escaping a dying local regime, that may still be valuable. As a clean, reliable hedge in a diversified global portfolio, the story is far messier than the slogans admit. It is important to separate two functions that are constantly blended together. One function is movement, the ability to move value across borders, around capital controls, away from fragile institutions. The other function is preservation, the ability to reliably hold purchasing power through violent storms. Bitcoin has already proven itself in certain cases as a powerful movement tool. Self-custodied and correctly handled, it can slip past gates that crush traditional accounts. It can connect someone in a broken financial system to a global pool of liquidity. That is not hypothetical. That is documented reality in multiple countries. But being an escape route is not the same as being stable insurance. One is about speed and permissionlessness. The other is about behaving predictably when everything is on fire. History does not define a hedge by its marketing copy. It defines a hedge by its behavior in the worst weeks and months, when trust is broken and options are few. Gold was not valued because it constantly soared. For long stretches, it was boring. But in wars, hyperinflations, and state collapses, it usually did not go to zero. It held some purchasing power when paper promises and political assurances did not. It stayed alive. Hedges tend to share a few quiet traits. They are often dull until the day they matter. They do not demand constant attention or narrative maintenance. People hold them reluctantly, as insurance, not passionately, as identity. They are ballast, not entertainment. Bitcoin so far has been the opposite. It is not dull, it is violently volatile. It does not sit quietly in the corner of a portfolio. It hijacks the entire mental space. People do not whisper about it the way they once whispered about buying a few bars of gold. They build identities around it. Whole online tribes orbit its price. None of that automatically disqualifies it as a potential hedge, but it should make anyone cautious about equating it with the things that historically earned that title. A speculative asset can sometimes act like a hedge in certain local or temporary scenarios. A high-flying stock can accidentally preserve your wealth during a local currency crisis if the timing lines up just right. That does not make it designed for that purpose. It makes you lucky. The core problem for Bitcoin as a dependable FX hedge is simple. Its price is still driven more by global liquidity cycles, speculation, regulatory headlines, and macro risk appetite than by slow, steady, defensive demand from people hedging currency risk. That balance may shift over time. Adoption could change the dominant forces. But history judges assets on what they are, not on what believers promise they will become. Look back across centuries of currency breakdowns, and a rough hierarchy of survival repeats itself. When money fails, what tends to protect you is real assets that produce something, access to stronger currencies that others still trust, and the ability to move yourself and your capital. After that, sometimes, if you are early, informed, and prepared, speculative assets can play a role as well. Bitcoin can intersect with this hierarchy. It can support mobility by letting wealth cross borders in an intangible form. In countries with extreme restrictions, it can serve as a bridge to harder units like dollars or stablecoins. In places with collapsing local units, it can simply be less bad than holding the local unit itself. That is not insignificant. But history is unforgiving about what truly endures over multiple cycles. It tends to favor assets with intrinsic utility or cash flow that are hard to arbitrarily create, that exist in deep and broad markets even during stress, and that do not require a constant stream of narrative oxygen to justify themselves. Bitcoin partially fits this and partially does not. It is hard to seize if handled correctly. It is hard to counterfeit. Its supply schedule is transparent. It trades globally. Under certain political regimes, those traits are priceless. At the same time, its market structure is still highly speculative, highly reflexive, and highly sensitive to leverage and sentiment. So who does Bitcoin actually help the most in currency crises right now? The answer is not everyone equally. Slogans talk like that. History does not. Bitcoin tends to help those who understand what it can and cannot do, who accept its volatility, who use it as a bridge rather than a bedrock, and who combine it with more traditional forms of protection. It can be a lifeline for someone trapped in a failing system with no legal path to dollars. It can be a powerful tool for moving value out of reach of reckless authorities. In that context, its instability may be a cost worth paying. For someone sitting in a relatively stable currency, imagining Bitcoin as a tidy, consistent hedge against ordinary FX fluctuations, the reality is harsher. So far, it has behaved more like a turbocharged bet on global liquidity than like a quiet insurance policy tucked away until needed. That does not make it worthless. It does mean that calling it the ultimate FX hedge is, at best, premature, and at worst, dangerously misleading for anyone who mistakes a narrative for a guarantee. The question, then, is not whether Bitcoin is pure hype or perfect hedge. Almost nothing in financial history is that binary. The more honest conclusion is this: Bitcoin is not gold with a user interface. It is not the dollar with a fixed supply. It is a new kind of asset still defining itself in real time. In a world more leveraged, interconnected, and fragile than most historical precedents, history does offer a few clear, uncomfortable lessons. Currencies fail more often than people want to believe. Governments almost always choose the survival of the system over the preservation of individual savings. Real assets, skills, and access to stronger units of account decide outcomes more reliably than ideologies do. Speculation rewards a prepared few, but destroys the unprepared many. Bitcoin stands right at the crossroads of all of this. It might, over decades, mature into something closer to a true hedge as speculation burns off and sober adoption grows, or it might remain what it mostly has been to date: a volatile, sometimes life-saving exit for the desperate, and a dangerous toy for the overconfident. The safest path is the one history keeps repeating. Do not outsource your financial survival to a slogan. Digital gold, perfect hedge, uncorrelated asset. These are stories. When pressure hits, behavior matters more than branding. If this shifts the way you see the promise of Bitcoin as FX hedge, subscribe. History has the answers. Look in the right places, and it will show you exactly what survives.